We're on to Chapter 2 of our textbook now, and I believe I gave you a warning that Chapter 2 and Chapter 3 it gets a little intense, a little difficult, so now we are going to start looking at the transactions, and we're going to get into the gritty parts of accounting where you're going to have to do some memorization and understanding how we do journal entries. Probably the hardest or most difficult concept for students to learn. And so, their warning, I've given you the warning. This one will be in PowerPoint 2 is going to be in two parts. The first part will cover our first two learning objectives, and the last part we're going to start talking about journal entries, T accounts, trial balance, classified balance sheets, and interpreting the current ratio and related concepts. So this PowerPoint, only the first two, which is identifying the effects of common business transactions, and then applying transaction analysis to those transactions. Learning Objective 1, the effects, the results. So when we do dual entry accounting, we have at least two of the financial elements that will be affected, that'll cause, there'll be causality. By having a transaction, there's a cause, and it will have an effect on these accounting financial elements. Under dual accounting, dual means two, we are going to have at least two accounts affected, all right? At least two of the financial elements affected by every transaction. Now we could have more than two, and one of these transactions in here will show us more than two accounts affected. And this effect then is going to increase or decrease. So for Learning Objective 1, Learning Objective 2, we're going to start thinking about common transactions. We're going to start thinking about the financial elements that are affected by each transaction. And we're going to talk about whether it increases or decreases. Now after that, when we get into our second PowerPoint on PowerPoint 2, then we're going to really start talking about journal entries. And this is a difficult area, so I'm going to do it in two PowerPoints because I think it's best to do that. So the accounting methods, it's a systematic accounting process that's used to capture and report the financial effects of a company's transactions. So what we do up here, if you look at this graphic in the far right, we are going to analyze, and then we're going to record, we're going to summarize it somehow, and it gets put into the accounts, and from those accounts we are going to prepare our financial statements. We have four financial statements. We know the income statement is going to be revenues and expenses. We know the balance sheet is going to be assets, liabilities, and equity accounts. But how do these balances change? How do these financial reports change? This is the process. So we're going to be talking now about the process. The first part is to analyze the transactions. So we're going to analyze transactions, and we're going to talk in this discussion on this PowerPoint about how the accounts are affected by the transactions. Okay? Then in our next PowerPoint, we're going to go through and we're going to take it further on through. Also in PowerPoint 3, we continue to discuss this. A transaction is a business activity that affects. Now affects means cause. It causes the basic accounting equation assets equal liabilities plus stockholders' equity to change. So it's a transaction. The transaction itself is a business activity that will cause the equation to change. The dual effects or dual accounting means that every transaction will have at least two effects on the accounting equation. Now, you can have a transaction that will cause assets to both go up and go down at the same time. That's quite possible, and we're going to see an example of that. But there are two accounts that are affected by what we do. Now, we have to analyze the thing. And to do this, we have to have what's called a chart of accounts. We got into this a little bit before because we were classifying items into their proper categories. We were saying some things were assets, some things were liabilities, some things were equity, using names and to classify. In accounting, we call these accounts. And the common method of approaching this is to not just have a name for an account, but to have an account number associated with that account name. If you notice over here to the left in this chart of account, which is a partial, they say, chart of account for a company because there'd be many different accounts for a company, you notice that cash, supplies, equipment, now logo and trademarks, I'll talk about that in a little bit, and then we have software. All these, the first number in the account number is 1. Interesting, all these are assets. So when the first number is a 1, it's an asset. Now the next two are payables, and payables are liabilities. The first number in those, 2. The last ones are equity. 3. Common stock, retained earnings, equity. They have account number 3. So it's quite common for a company to use an account number system for each one of their account names. There's a description over to the right about what each one of these are, so it's a definition of the accounts. We don't really need to know that because we covered most of these in the past. We know that cash is what cash is. We know that supplies, and there's a definition of what supplies. Equipment. This company has computer, printers, and desks as equipment. Accounts payable are owed. We know notes payable are owed, and those are our definitions. So we don't need to spend a lot of time on this. We just need to understand that we have a chart of accounts, and that whenever we have a transaction, we're going to have to pick from these accounts, and we're going to have to pick 2 accounts each time we have a transaction. That's all this is about. Here is one of our first transactions to think about. Their Sonic Gateway is going to be incorporated. It's going to become a corporation. And when it becomes a corporation, there's going to be a stock certificate issued, and common stock is going to be issued, and the company is going to get cash in. So with this transaction, there's a getting and there's a giving, and we are going to give away our common stock, but we are going to charge for that common stock, and the charge is going to be the cash which we receive in. So the transaction has 2 elements. Has to have 2 elements at least. We've said that. This, you can see it's cash, and you can see the other side is going to be common stock. So they receive cash and they give away common stock. Now another thing you need to remember with this is the dollar value has to agree. So we have to keep this thing in balance. If assets go up by $10,000, which is the cash received, then either liabilities or equity must go up by $10,000. So the amounts to the right of the equal sign have to go up by the same amount that the left side goes up. If the left side goes down, the right side, which is liabilities, equity, must go down by the same amount that the left side goes down. These are just our rules. So in this case, we get cash in of $10,000, and we have to determine where it goes on the right side. It's common stock. Common stock, as we said earlier, should be classified as stockholders' equity, so we put it on the right. We are in balance after this transaction because our assets have a total of $10,000, and our right side, which is liabilities with equity, have a balance of $10,000. Sonic Gateway pays $300 cash to create the company's logo. This logo would be something like, say, Nike has. It's a trademark. A trademark, we usually said that assets are things that are tangible, you can go out and touch. A trademark is something that's called an intangible because you can't really touch it. It shows up all over the place. They're going to put this trademark on their letterheads. So all the documents that the company sends out, it'll be there. It'll be on their website. It'll be on the outside of their building. If they have trucks, delivery trucks, it'll be on the delivery truck. So it'll be all over the place. I guess in a sense you could say, yeah, it's kind of tangible because you can see it. But it's not a physical thing that you could really pick up. So we tend to call it an intangible. You're going to pay $300 to have this thing. Does it have value? Of course, it has value. And so what we're going to do is we're going to receive this logo, we're going to call it a trademark, and we are going to give up cash for it. This is an example where we don't have any changes to the right-hand side of the equation. We only have changes to the left. And the changes to the left completely balance each other. In other words, assets goes up by 300 and also goes down by 300. Therefore, our left side, our assets, is really unchanged after this transaction. If we said, what are total assets after the transaction? We'd say, the effect of this transaction, there's no effect on assets because assets goes up, goes down by the same amount. And if that's the case, we don't have to worry about the right-hand side, liabilities and stockholders' equity, because the left-hand side doesn't change. Now we're getting a loan from the bank. Now, a loan, we are going to get cash. This is cash. And what we are going to do is sign a formal agreement that says what I owe you, which is a payable. A payable is a liability. So the two accounts affected by this are going to be the asset, which is the cash coming in, which we get in, and the payable, which is going back to the bank, or which is going to be owed to the bank. So if the cash goes up by $20,000, we know also that there has to be a change to the right. It's not stockholders' equity, which would be common stock or retained earnings. It's going to be liabilities. It's that payable which is owed. We are back in balance because with this transaction, assets go up, liabilities go up by the same amounts. We are in balance. Investing in equipment. We are going to buy equipment. And instead of paying for it with cash, we are going to promise to pay, which sounds like an IOU, doesn't it? So we are going to get this equipment in, which is an asset, and we are going to agree to pay for it in the future. So we are incurring a liability. Therefore, the left side goes up by $9,600. The right side must go up by $9,600. This expression, pay on account, means that we are going to incur a payable. That's what that expression means. And the left and the right have to go up by the same amounts. In this case, $9,600. When we pay off our supplier from that transaction, here you notice it says D. This refers to our previous slide where we incurred an amount that was owed for having made that purchase. We are going to pay $5,000. I don't believe this is a total amount which we incurred as our liability. We are only making a payment on it. And as such, our cash is going to go down, and when we make the payment, we no longer owe the total amount. We can reduce the amount we owe by $5,000. So our total IOU balance is going down by $5,000. When we order software, now software is an interesting thing too, because software is something that you could think of as an intangible, or you could think of it as a tangible, right? The software in this case, we are signing a contract and ordering it, but we didn't get anything. If you do not get anything, you really don't have a transaction. Okay? So at this point, it's only a promise. They say it's an exchange of promises. It's not a true transaction. If there's no transaction, there's no effect on this at all. So there's no change. Now, when we do get the software in, we are going to pay for it with cash, and we're also going to promise to pay or incur an IOU for the remainder. This occurs to me that we are going to have more than 2 accounts affected by this transaction because of what we give up. You're going to give up cash and a liability. So this is 3 accounts affected, not just receiving and giving, but receiving one thing and giving up 2. So now we have to think about the 3 that are affected. Well, we are going to get that software in, which had a value of $9,000, and its value is determined by what we are giving up. We are giving up cash, and we're giving up cash in the future, which is represented by this accounts payable. We eventually will have to pay off this IOU, which is a $5,000 in the future at some point in time. Notice here that always the left side and the right side are still going to be in balance because the asset side is going to go up by $5,000 and the liabilities is also going to go up by $5,000. Assets will go down by $4,000, up by $9,000. The net effect is a $5,000 increase. We receive supplies on account. Again, when you say on account, it means we did not pay cash. We agreed to pay. So supplies go up by $600, accounts payable go up by $600, which is a liability. We're in balance. We continue to be in balance. Now, one method to summarize all these effects, because at the end you're going to have to prepare those financial statements. And so far, what we have been looking at have been only the balance sheet accounts. We're going to have to prepare this balance sheet, and if we wanted to prepare a balance sheet at the end of the month, the balances would have changed. We had cash coming in, we had $10,000 coming in, as you can see from the spreadsheet. We gave up $300, we had $20,000 coming in, we gave up $5,000, we gave up $4,000, and in the end, our balance is now $20,700. And supplies, we bought supplies. Supplies went up by $600. We had equipment. It looks like we bought some equipment, $9,600 in there. We have software, $9,000 going up. We have logos, trademarks going up by $300. And then we have the changes that are required from both incurring payables and paying off payables, which change the balance in those accounts. We issued stock, and for return for the stock, we got in cash. So if you take all those transactions and we're putting them in Excel, if you put them in Excel, you would come up with a spreadsheet that would show the changes in balances. You would get to the ending balances. And when you get the ending balances, you create another balance sheet. This is just one way to do it. This is not the preferred way. This is not the way we'll be doing in this class because we're going to go on to T accounts and we're going to go on to journal entries. So for now, I'm going to end this recording at this point, and we will be continuing with our next spreadsheet in which we will be going through this, and we will be taking it further using T accounts and trial balances.